Let's look at two investors on the exact same starting line. Meet Jake and Marcus. They are both 30 years old, earning $75,000 a year, with an identical goal: invest $1,000 a month for 30 years to retire comfortably. But their approaches to reaching that goal are completely different. Jake builds a portfolio of individual stocks. He picks a dozen names he believes are the highest quality companies in America, like Microsoft and Apple. He spends 4 or 5 hours a week digging through earnings reports and financial news. He treats investing like a carefully curated craft. Marcus does something almost embarrassing by comparison. He opens a brokerage account and buys a single S&P 500 index fund every single month. He does absolutely no research. He has no thesis on the latest tech trends. He simply buys a microscopic slice of the entire US stock market and walks away. When the two of them talk about money with friends, Jake always has a story. He has positions to defend and big stock picks to brag about. Marcus has absolutely nothing to say. Nobody wants to hear about an index fund. To Jake, Marcus's approach doesn't even feel like a strategy. It feels like giving up. But feelings and math are entirely different things. Over the next 3 decades, the approach that feels socially uninteresting is going to set a mathematical trap that catches almost every active retail investor. For the first few years, Jake looks like he is making the obviously smarter choice. His growth positions in companies like Tesla shoot up 80%. His Apple shares rise 40%. He talks about these wins on group chats, and he genuinely feels like he is outsmarting the system. But there is an invisible side to Jake's ledger that he doesn't talk about. He quietly sold 2 stocks for a loss last year. He stopped putting money into another position after it dropped 30%. And he's holding on to dead money purely in the hopes it eventually breaks even. Marcus isn't navigating any of that narrative volatility. His experience is completely flat. He just watches a single number slowly tick upward on a screen. There are no corporate thesis updates to track and no abandoned losers to quietly bury. We remember our big wins because they feel good, and we forget our losses because no one wants to admit them. The human brain naturally builds an emotional scorecard. That scorecard permanently obscures the true mathematical costs bleeding out of our actual brokerage statements. In 2018, a finance professor named Hendrik Bessembinder ran the numbers on nearly 26,000 common stocks that have traded since 1926. He wanted to know how many beat 1-month Treasury bills over their lifetime, just the safest government bond in existence. 57% of individual stocks underperformed basic government bonds. When calculating total dollar wealth created above Treasury bills, 100% was generated by the top 4% of companies. Staggeringly, out of 26,000 companies, just 86 individual stocks accounted for half of all market wealth ever created. By owning the entire market, Marcus automatically captures every single one of those 86 extreme winners. Jake, picking 12 to 15 stocks, has to constantly hunt for the next generation of rare anomalies and find a way to hold them. Capturing the market's total return depends entirely on guaranteeing exposure to that specific cluster of extreme, rare outliers. Standard & Poor's data shows that 89% of full-time, active large-cap fund managers fail to beat the market over a 15-year period. Jake is attempting to beat those exact odds on his weekends. Every time Jake takes profits, sells a loser, or rotates his portfolio, he triggers a taxable event. Over 30 years, that active turnover generates roughly $63,000 in federal taxes. Marcus's highly efficient ETF structure leaves him with a tax bill of just $8,500. Retail investors consistently panic sell during crashes and hold on to losing companies out of pride. Those emotional errors cost stock pickers 2 to 4% annually and demand 7,800 hours of unpaid research time over 30 years. Indexing has its own limitations. By holding the entire market, you are forced to own the 96% of companies that are mathematically mediocre. And because the index is market cap weighted, massive companies like Amazon and Apple dominate the fund's movement. When a few mega caps correct, they drag the entire fund down with them. There is also a psychological vulnerability to indexing. You possess zero domain edge, and you have absolutely no emotional relationship to the assets. Without a thesis to anchor you, it is difficult to maintain conviction when the market drops 30% in a single month. When you account for the combined friction of taxes, fees, and behavioral errors, the statistical advantage shifts towards strategies that prioritize mechanical efficiency over personal expertise. Let's fast forward their accounts to year 10. Jake sits at roughly $171,000, while Marcus is at $192,000. The $21,000 gap is real, but Jake remains blind to it because his emotional scorecard only tracks his current portfolio against his past performance. By year 15, the separation is obvious. Jake hits $311,000. Marcus hits $374,000, a $63,000 gap. By year 20, compounding takes over. Marcus reaches $658,000, while Jake is left at $508,000, a massive $150,000 deficit. To understand the severity of that deficit, think about the raw labor involved. That $150,000 gap represents the total equivalent of more than 12 years of Jake's strict $1,000 a month contributions, entirely erased. Building wealth over 30 years requires checking your ego, eliminating friction, and using a structure that guarantees you hold on to the market's rarest outliers.
Meet Jake and Marcus, two investors with identical portfolios on a 30-year journey. Jake is an active stock picker, Marcus a passive index investor. Jake is doing everything we are taught a smart investor should do. He puts in the hours, researches the fundamentals, and buys into great companies. Every month, his brokerage statement shows his account balance going up. His winning picks confirm his strategy is working. He feels incredibly successful. This graph plots their portfolios over 3 decades. At retirement, Marcus's index fund has grown to $1.78 million. Jake's carefully managed stock portfolio sits at just $1.17 million. That is a gap of $615,000. How did Jake miss a 6-figure shortfall? Because active investing hides its true cost. When you pick stocks and underperform the market, it doesn't feel like losing money. Your account is still growing. It feels like winning, just slightly less than the broader market.
Jake never made a single catastrophic bet that wiped him out. Instead, 3 invisible, compounding leaks ran quietly in the background for an entire 360 consecutive months. Together, they drained the equivalent of a fully paid-off house from a seemingly thriving portfolio. Here is where every stock picker raises an objection. If Jake had simply bought Nvidia in 1999 or Amazon and held onto it, he would be retiring wildly richer than Marcus. And that is mathematically true. Real people achieved those exact outcomes. But look at this chart of Cisco Systems. In March 2000, Cisco was the unquestioned Nvidia of its era. The entire internet was being built on their hardware, and every Wall Street analyst was bullish. On March 27th, the stock hit a peak of $806. If you bought Cisco at that obvious peak, you spent the next 25 years underwater. You wouldn't have broken even on the price until December 2025. The stingaries about buying Nvidia in 1999 are told by people who already know how the story ends. This distribution curve reveals how the stock market actually functions. A mere 4% of publicly traded companies drive all of the market's long-term returns. The vast majority of individual stocks severely underperform. Marcus automatically captures every single one of those massive winners from day one of their public listing, simply by owning everything. Jake, by trying to isolate his bets, runs directly into concentration risk. He is mathematically punished for guessing wrong. Relying on tales of legendary single stock trades ignores the steep mathematical odds against you. You have to identify that specific 4% in real time and hold through brutal drawdowns without the safety net of hindsight. Beyond the math, Jake's portfolio suffers from behavioral friction. Human psychology tempts us to sell our losers at the absolute bottom, and we get impatient and abandon stagnant positions just months before they finally rebound. Then there is the physical removal of capital. Because Jake is actively managing his picks, his portfolio turns over 15 to 30% every year. Every time he rotates a position to take a profit, he triggers a realized capital gain, pulling cash out of his compounding engine to pay the IRS every April. This visual compares their total federal tax burden during accumulation. Over 30 years, Jake bled approximately $63,000 in taxes. Marcus's exchange-traded funds use an internal creation-redemption mechanism that rarely triggers taxable distributions, costing him only around $8,500. This penalty continues even at death. If Marcus passes his index funds to his heirs, they receive a legal step-up in basis. The cost basis resets to the value on the date of death, wiping decades of capital gains entirely clean. Jake's portfolio has been bled dry for 30 years, with no way to recover that lost capital. Continuous yearly tax leakage slowly suffocates a portfolio's ability to compound. Passive indexing is explicitly engineered to bypass that exact friction. Jake's outcome is the statistical norm. According to 20 years of SPIVA data tracking global equity markets, 90% of professional active managers underperform their benchmark index over a 15-year period. Retail investors trading on their phones generally do even worse. The financial industry rarely highlights this data. There is simply no scalable, highly profitable business model built around selling you a boring, low-cost answer that requires zero ongoing maintenance. There is a narrow exception for genuine domain experts. A semiconductor engineer reading chip papers, or an oncologist who deeply understands a specific drug class, operates within what Warren Buffett calls a circle of competence. Their specific, highly localized picks carry a mathematical edge. Most retail investors do not have a circle of competence. They have a circle of confidence. Confusing the two is a very expensive mistake. Unless you possess elite, localized knowledge in a specific sector, competing against the mathematical certainty of the total market index is a proven losing battle. So, what actually works for the average investor? Step 1 is securing your foundation. Build your core wealth in broad, low-cost index funds during your accumulation years. This guarantees you automatically capture the top 4% of companies, driving all the market's returns. Step 2 is compartmentalizing your risk. If you truly want to pick individual stocks, cap that allocation at under 10% of your total portfolio. Treat those picks as educational entertainment to keep you engaged with the market, not as the primary engine meant to make you rich. Step 3 is optimizing the location of those trades. Any active stock picking must be housed exclusively inside a tax-advantaged account, like a Roth IRA. Doing this completely neutralizes the compounding tax drag, ensuring you aren't paying the IRS every April for the privilege of trading. The true goal of investing is not feeding your ego by guessing which garage startup becomes the next Apple. It is utilizing boring, mathematically sound logic to capture guaranteed market returns and quietly securing your long-term financial freedom.